Hey, Dustin Tibbetts here, financial advisor with Jazz Wealth Managers. How will your retirement investments do through the month of September? It's off to a really tough kind of a start, huh? Well, I wanted to kind of share some stats with you here today and share something I actually share with clients that we don't normally do here, but know that September is historically the weakest month of the year, all right? So you may have seen this before. Let's dive over here and look at this. We use the Dow, so we can go back 100 years in this case, and we're looking at the average monthly change in percentage terms for the Dow. So for example, over the last 100 years, you could probably see it up there. Oh, the cursor's not working. Last 100 years, January averages a gain of about 1%. Okay, fine. February tends to be flat, blah, 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 blah. You come all the way down here. September is one of the only months that averages a negative return, and it averages the worst return out of all of them. It's only positive 40% of the time. In other words, it's only positive 40 out of the 100 years that we're looking at here. Well, things change. You know, obviously the Dow was made up of different components 100 years ago than it is now. So let's look 50 years. What's still the worst performing month of the year? Only positive 36% of the time, and has a loss of about 1.28%. Last 20 years, very similar, right? So that's the first part. So we say, well, how are my retirement investments going to perform in September? Well, if they fall a little bit, which they kind of, you saw today, then it's kind of expected. That doesn't mean we're going to just fall apart and the world's going to come to an end. It's a seasonal trend that the market, for whatever reason, gets a little weak in September. Add to that, it's an election year. We got the rate cut coming up. There's so much going on there. There you go. Okay, a lot of moving parts. Got it. It's going to be a little wild. The other part that I want to share with you is just a little bit different, and this one might take a second to explain. If we look at the stock market's average returns, and in this case, we're using the S&P. So the average, in light blue here, the average one-year return is 11.9%. Okay? Now, when people say, oh, the market gains 7-8% a year, well, that's because they're saying after inflation. So whoever sees this and goes, oh, wait a minute, I thought the S&P only averaged a 7% return. Well, it used to be 9.9%, and now it's 11.9%, but then you back out inflation, and that's how you come up with that number. So anyways, the average one-year return, 11.9%. All we're doing is saying add up every single year's returns since the very beginning of the S&P and give me the average, right? The average two-year return, 10.6. The average five-year return, 10.5, and so on, right? Now, we then do something a little different here and say, well, let's look at the current one-year return and compare it to the average. So that's that big green line you see over there, 26.2. In other words, and this is a very short time period, but over the last 1 year, the market has gotten ahead of its average by more than 100%, right? It's like double. So you say, okay, well, great. The market has moved a little too far, too fast relative to its average, but that's only 1 year. So if you look at the 2-year, our current 2-year return is 21%. The average 2-year return for the S&P over its entire lifespan is 10.6. In other words, you just add up every 2 years and then take the average of that. Add up every 5 years, average of that, see? So if we look in the really short term here, the 1, 2, and 5 year, the market is just, well, in some cases, way ahead of itself. In other words, it's overgrown a little bit too fast. Add to that we're in the month of September, which is historically and seasonally, it's a weak month, right? You have a recipe for people go, yeah, I don't know that I want to pay top dollar right now when I know there's all this kind of chaos out there. So it doesn't mean that your retirement investments are going to fall apart. At the moment, it means that they are pulling back, and that's the time to go shopping, right? Go look to see if things get a little bit worse. Is there somewhere that you may want to add to your portfolio? Things like that, right? Anyways, just wanted to share that with you because it was a bit of an interesting day, I thought, and we'll see what happens. Hey, enjoy the rest of your evening, and thanks for watching. Check us out at jazzwealth.com. We're like the only advisors that can actually talk about the stock market and share cool data with you as well. Adios.